Start with revenue sources. Do not stop at total revenue growth. Ask where the money comes from. Product sales, subscriptions, commissions, advertising, interest spreads, management fees, usage charges, licensing, or one-time projects. Each source has a different quality. Subscription revenue can look stable, but churn can damage the model. Project revenue can grow quickly, but visibility may be weak. Advertising revenue can move with the economy, traffic, and platform rules. Next, study the cost structure. Revenue is not value by itself. Every dollar of sales has costs behind it. Some companies pay for materials, logistics, rent, and labor. Others pay for research, cloud infrastructure, sales commissions, customer acquisition, licenses, and depreciation. If costs rise almost as fast as revenue, scale may not improve. If fixed costs are high, a small revenue decline can create a large profit decline. Then compare gross margin and operating margin. Gross margin tells you whether the product or service has room between price and direct cost. Operating margin shows what remains after running the business. A high gross margin is not automatically attractive if the company must spend heavily on sales and development to keep growth alive. A low gross margin is not automatically weak if turnover, capital efficiency, and customer retention are strong. Customer dependence is another major risk. If revenue depends on a few large customers, the growth story may look good, while bargaining power belongs to the customer. A delayed order, a price cut, a supplier switch, or customer insourcing can damage both revenue and margin. Useful questions include: how much revenue comes from the largest customers? How long are contracts? How painful is switching? And can the company diversify demand? Supply chains and key resources also shape the model. Some businesses depend on specific raw materials, chips, production capacity, skilled labor, licenses, distribution channels, or platform access. If supply tightens, costs rise, or a platform changes rules, the model can be repriced quickly. Growth is rarely a straight line. Critical resources often decide whether the line can continue. Pricing power is one of the strongest signs of a durable model, but it must be proven. A company may have pricing power because of brand, data, technology, distribution, switching costs, network effects, or service depth. The evidence is not the claim. The evidence is whether customers stay after price increases, whether competitors can undercut the company, and whether volume remains healthy without constant discounts. Growth quality matters. Growth can come from more customers, higher prices, more usage, new markets, new products, acquisitions, or accounting timing. Each source has a different risk. New customer growth requires attention to customer acquisition cost. Price growth requires churn analysis. Acquisition growth requires integration and debt discipline. Temporary demand should not be mistaken for a permanent engine. Cash flow is the reality check. A company can report profit while receivables stretch, inventory rises, or capital spending consumes cash. Free cash flow asks what remains after operating needs and reinvestment. For investors, a business model eventually needs to show cash evidence, not only adjusted metrics. If profit grows but cash does not follow, the model deserves extra scrutiny. Capital needs decide how much the model depends on financing conditions. Asset-light companies may still need heavy research and customer acquisition. Asset-heavy companies need plants, equipment, inventory, maintenance, and working capital. The more capital a model needs, the more sensitive it can be to interest rates, credit availability, and management capital allocation. Every company study should include failure conditions. Do not write only the bullish case. Write what would force a reassessment: falling gross margin, rising churn, longer inventory days, weaker cash conversion, higher financing cost, lower return on research, stronger regulation, platform fee changes, or aggressive competitor pricing. These triggers are not for daily panic. They create discipline. A practical business model map has 4 columns. Column 1, how the company collects money. Column 2, the main costs and capital needs. Column 3, evidence of pricing power or competitive protection. Column 4, the conditions that would break the thesis. If those columns cannot be filled, the investor may be buying a story rather than understanding a business. Also, avoid confusing a good product with a good investment. Customers may love the product while unit economics remain poor. Revenue may grow while shareholder cash flow stays weak. The industry may be large while one company fails to defend profit. Product, company, industry, and purchase price are different questions. This video focuses only on the company model before valuation. Peer comparison should also be careful. Two companies in the same industry can have very different revenue quality, customer concentration, cost flexibility, balance sheet risk, and cash conversion. Do not compare only price to earnings ratios or revenue growth. Compare margin stability, working capital, customer concentration, capital needs, and failure triggers. Use the map in a repeatable process. Before studying a company deeply, fill the 4 columns. After each earnings report, update the evidence. When the share price rises, ask whether the business model improved or only valuation expanded. When the share price falls, ask whether failure conditions actually appeared. This process can reduce the chance of being pulled around by headlines.